Hey, this is Scott Cole from TrendFollowingUniversity.com, and before you proceed with the current video, please read this disclaimer. Take a moment, pause your video, and check out this disclaimer regarding the risks involved in futures and options trading. Thank you. Hey everyone, Scott Cole here from Trend Following University, and in this video I want to cover the trend following mantra known as cut your losses and let your profits run. In this video we're going to test the turtle system number one, which involved buying a 20-day breakout and selling the market when it goes 10 days against, or selling a 20-day breakout and buying when it goes 10 days against your position, and also employing the 2N hard stop loss that was part of all three of the mechanical turtle systems taught by Richard Dennis and William Eckhart. So what I've already done is I've tested this strategy on a portfolio of 40 of the most liquid futures markets traded here in the U.S. And we've only traded one contract at a time. So overall, it says that we've made about just under $2 million in profits, 1.489 million on the long side, and 420,000 on the short side. However, because each futures contract has different specifications, we certainly would not, if we were trading a portfolio, say with $1 million, which is what we're going to test next, we would not trade just one contract at a time in each market that we're trading because of the different specifications. For instance, what we want to do is give them equal weighting so that, say, one natural gas contract might be equal to a number of Eurodollar contracts, because the volatility in both markets is different and they have different contract specifications as well. So that's what we do when we test a trading system on a portfolio. We certainly are not going to just trade one contract at a time, because as you're going to see, the results get skewed. If we only traded one contract at a time, you can see that we might be profitable, and this is often what many of the system vendors will show you. But in actuality, when you're trading a portfolio and you're employing some money management algorithms, this is not going to be the case. Now, what we've already done is we've tested this strategy now in our trade plan using this turtle strategy, and we've actually lost over $800,000 going back to about the year 2000. And we can see all the different trades here. We've got the buy stop, and here's the average true range stop loss, which would be the 2N stop on that particular trade in cattle. And you can see we've got every single trade that's been completed with the strategy, along with the number of contracts traded as well, which would be this column size. So this first trade here, December 13, 1999, we traded 17 live cattle contracts. That's the symbol ZT with the data that I use. We sold them at 133.42.5, and we covered at 134.875. So we had a total loss on those 17 contracts of over $11,000. So you can run on down and see all these results here. On an annual basis, 2000 was a good year. We made 38%. 2001, 14%. We were risking 1% of our equity per trade. 2008 was a big year, up 183% or so. The last 3 years have been abysmal. So what I'm going to go ahead and do now is we're going to test a different variation of this model, but we're going to take out the 2N hard stop loss and see how just the basic entry and exit strategies work but we're still going to limit our risk to 1% of our equity, and we're going to base that figure on the average true range as well. So even though we're not going to use the hard stop loss, we're still going to risk the same amount of equity. So let's go ahead and what I have to do is I've got to bring up a different trading model here, and I call it Turtle 1B here, and I'm using the Trader Studio software program. And we are going to use the 25 and 75 for commission and slippage. And we're going to trade that same basket. And what we're doing first is we're testing one contract at a time. And we're going to let that run. That's going to go all the way back to 1969, even for some of the markets, even though I don't need the data going that far back. So I'm going to go ahead and pause the video. At this point, we'll come back when this particular part of the test is complete, and then we'll be testing it with the trade plan where we actually vary the number of contracts traded in each market. So I'll go ahead and pause now. Okay, so we're getting ready to see the results of just trading one contract at a time without using the 2N hard stop loss. And they'll be coming up, these results will be coming up here momentarily. And this time we have just over 1.8 million in total profits, and I believe that figure is a little bit below where it was the last time. However, now we're going to employ the money management algorithm so that we're going to be trading more than one contract at a time, as you can see right here. So we're going to get that started, and the trade plan is reflecting the fact that there's a new system in place that's being tested. We're going to run it. Again, we're going to risk 1% of our equity on any given trade. We're going to go back to about the year 2000 on this test, and we'll go ahead and click that. As you can see at the bottom of the screen, it's starting to run the process. And we'll go ahead and pause the video and come back when it's all done. Okay, so we're calculating the results of this test now. And as you can see, compared to our last test where we lost about $805,000, this time we've only lost $762,000. We made quite a bit of money on the long side, but we lost money on the short side. Here's the yearly breakdown. Again, the last 3 years were pretty brutal. So overall, as you can see, this mechanical turtle system really is not a good system in the current environment to trade mechanically. And if you subscribe to our course, we actually cover the idea that the systems taught to the turtles were never meant to be traded on a mechanical basis anyhow. But we can see the trade-by-trade basis. So here's that cattle trade again back in December 1999. And we go on down the line. This time we don't see any of the average true range stop losses. Instead, it's just the 10 days against stops that we're using. And some of them result in profitable trades and others losses. So before you ever consider trading any kind of a trading system whatsoever, make sure you research it thoroughly. It appears that this 2N stop loss might have been some kind of randomly selected stop loss by Dennis and Eckhart, really to be employed to help the traders from a psychological standpoint rather than from an actual profitability standpoint. Because based on this hypothetical testing, the stop loss actually reduced performance, at least modestly. So with that thought in mind, for more information on our trading course, visit our website, trendfollowinguniversity.com, if you're viewing this video on YouTube and not at our website. But come check us out and consider our online trend following trading course. And we'll see you down the road.